Hey traders, welcome back to the Algorithmic Advantage. Happy to have you here. So glad to be doing this. So glad you're a subscriber. Really appreciate it. It makes a huge difference. Now listen, if you're not a newsletter subscriber, you may have missed the huge news that Algo Advantage is launching courses, community, and a whole lot more. It's pretty epic. It will be happening very soon. It's about to drop. If you're on the newsletter list, you'll hear more about it. Let me quickly tell you about the memberships. I'm talking about access to a forum with myself, with quants, with market wizards, with my trading buddies, fund managers. It's going to be amazing. I know that will warm up slowly. So meanwhile, there are going to be AMAs, Ask Me Anything webinars with myself. We're going to deep dive strategies, mentorship, unpack critical themes, topics from the pod, you name it. I'm going to give members access to my order management system, and I mean the full Python code in GitHub for a couple of bucks, so we can continue to work on that together. I'm going to be releasing additional podcast chats, webinars with top traders. Then there's a series with top traders that I'm working on. It's unbelievable. But to top it all off, I've got Tom Stark, who's going to show up once a week, maybe once every 2 weeks, and we're going to just go step by step how institutions do quant research to find real edges. If you knew the edges that Tom was finding, if you knew the sharp of the strategies he was trading, you wouldn't believe it. So this is where you want to be, and this is the guy that you want to learn it from. Super excited about this. We've had Tom on the pod earlier on. We'll get him back. You can go back and have a listen to that. Tom knows his stuff, works for a big quant firm, and that's going to be just unbelievable. So anyway, check out the website, the new website, www.algoadvantage.io. That's the new site. As for the first course we're going to launch, I'll quickly mention it's going to be absolutely epic. It's in crypto, an extremely comprehensive course on crypto edges. I mean, there's so much content in here, like edges in Bitcoin, alts, full codes, stats, deep explanations. And yes, it's all from David Bush, who is an awarded fund manager, and he has been working in this space, building some strategies in crypto for quite some time now. You can check him out from episode 7. Of course, we will get him back to talk crypto very soon. Guys, I'm super excited about this and looking forward to it all launching and having you guys in the community where we can, really take all this to the next level. If you haven't seen it on the new website, start to sniff around in there, algoadvantage.io. Thanks heaps. Let's get on with the show. Right, Nick Radge from The Chartist, the author, trading educator, mentor, fund manager, trader since about 1985. He's a legend here in Australia, and I think it's all summed up in 2 words: experience counts. And I'm not just talking about fishing.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field.
Nick, a huge pleasure to finally get you on the show. I'm extremely honoured to have you here and happy to be chatting.
Thanks, Tom. Looking forward to it. Thanks for having me on.
Fantastic, mate. Let's jump into it with, a bit of a background, because I do like your backstory. So, please remind us of a little bit of that, interesting story of starting off in Sydney and ending up in the SFE, getting fascinated by the charts and, your path in futures from there and how you got started.
Sure. Well, it was all a bit of an accident. Certainly wasn't planned. I had no idea what I wanted to do when I left high school. So I went and actually got a job at a Commonwealth Bank branch just because I had nothing else better to do. And a friend of a friend, he was the accountant at a big blue chip stockbroking firm, Potter Partners, back in those days. And he had a job just pushing paper. So it ticked all my boxes. Wearing a suit, catch a train, work in a building seemed pretty good to me. So that's where I went. I had as I said, no idea what the financial markets were about, nothing like that at all. My father had been a very passive buy and hold investor, but we'd never discussed that in any way, shape, or form. So, I had no expectations of what was going to come of it. It was just basically a clerical job. So, Potter Partners is a stockbroking firm, but they did have a fixed income desk, and that fixed income desk did do a lot of hedging using futures, interest rate futures, which were prominent on the Sydney Futures Exchange. So my job, Potter Partners, was an associate member of the exchange, which allowed them to do their own clearing for their business. They did not have an execution seat, so they weren't actually on the exchange per se. So it was my responsibility to just do all the administration and reconciliation of their trades for that fixed income desk. So that's what I was doing, pushing paper. So I was doing that for a while. Again, no real interest in doing anything other than that. Certainly nothing interesting in the financial markets. But I did happen to walk past the retail desk and retail stockbroking desk, and there was a guy there with chart paper, the old chart paper, and a couple of different coloured pens, and he was plotting the share price index futures. And back in those days, those futures were $100 a tick. And he just had a 5 and 10 day moving average on that. And, it was one of those sort of light bulb moments. You could see the trends. It was just, don't get me wrong, this was 85, 86, massive bull market running into the 87 crash. So there were beautiful trends. And I was earning, 11 grand a year. And I thought, yeah, I can do that. Why not give that a go? So I went and bought my own chart paper and pens and started plotting it. Out of the financial review each morning, I'd plot open, high, low, close and calculate my moving averages. And then I went into the wily old office manager who had seen it all, thought he'd seen it all, until I walked in there and told him I wanted to open a futures account. And back then, the SPY futures were $100 a tick, not like they are today at $25 a tick. So it was a bit of a dumb call, but I was young and stupid. But he allowed me to start trading, and so I started doing that, and that's how I fell into it. So
yeah, awesome.
Never looked back from there.
So you ended up at the futures exchange, and then you ended up, I guess, working for some banks and traveling internationally, and then trading, your own sort of CTA. Is that right?
Yeah. So what happened was I got pinched from a floor broker, and so they had a membership to the trading floor. So they actually had a presence on the trading floor there. I was still pushing paper in their back office, but when 87 crash came along, they did ask me to come down the trading floor and just fill in wherever I could. So that was quite the experience. And a few years later, about I think 89 from memory, I actually got moved down to the trading floor. Obviously, as you know, trading floor, lots of young blokes with a lot of testosterone and ego and that kind of stuff. So they just added another one to the mix, and that's where it was. I was in the bill pit, executing institutional paper. So from there, I went up to the international desk, dealing international futures. And my boss had said to me that at the time, she said, if you ever want to do anything big in this industry, you've got to go and work overseas. So I gave them 12 months notice that I wanted to go and do that. After 12 months, nothing came of it. So I took the initiative, went to London and started up at HSBC over in London. I started an Aussie desk over there, which was a great success. In fact, the guy that I brought over within 3 months to help me is still there today, 25, 30 years later. So at the end of the 12 months, I was supposed to be in the UK for 3 years, but at the end of the 12 months, they asked me to move across to Singapore. They'd lost a lot of staff over there. So went across to Singapore, very, very different culture. London was unbelievable. In hindsight, it was just remarkable. Singapore, different culture, very different. So I did 2 years there, and during this period of time, I used to deal with a lot of the hedge funds and CTAs in the US, and we'd seen a lot of the systematic traders come in on the trading floor. Actually, these guys would come in with massive orders, and it always tweaked my interest as to why they're doing this, and I found out that it was all systematic in nature, all computer driven. And that set me on my way to start doing that kind of stuff, researching that. So, back in the early 90s, I got a computer. I got back what's called Supercharts, which is today's TradeStation, which is still around, and started coding my own very, very simple systems. And that's where it all really started. So I kind of went from a rule-based method of moving average crossovers into more hard-coded kind of systematic. So that's all I've ever done. I've never done any fundamentals. I've never tweaked into that area or anything like that. It's all been purely technical, and I still do that stuff today.
What motivated the move, Nick, into equities? And, I kind of want to ask, do you miss the diversification of futures at all?
So, yeah, that's a really good question. I came back from Singapore in the late 90s. I developed a fully systematic trading system for futures trading, and we traded a big portfolio, I think about 45, well, I'd say a big portfolio. So these days it's not, but 45, 50 futures markets back then around the world. And, I set up my own fund. My business partner used to be an ex-prop trader at UBS in Hong Kong. So we got a lot of expat money out of Asia, and we were managing that money using a purely systematic futures fund. Now, the business was going fine. Due to various reasons, he decided to leave the business in 2001. That's when ASIC created all the new laws, and things became that little bit much more complicated and complex, if you like. So I made probably a pretty bad business decision in hindsight to roll that into a major Australian bank. Now, interestingly, the division that I rolled that into, they were also doing equities. Now, you just asked what the reason was to move to equities. And from a funds management standpoint, you can manage a lot more money with instruments people understand. So with futures, okay, I could manage, say, $10 million, but for every 10 million I could raise doing futures trading, I could probably raise 50 million or more doing equities. And that's a simple fact that for the very vast majority of people, especially retail, wholesale investors, as opposed to institutions, there's I guess an underlying wariness of leveraged futures, that kind of stuff. So they're kind of a little bit scared away. So without that impediment, I figured you could raise a lot more money doing equities. The other thing was, because I'd spent my whole career up until then, about 17 years, on the futures side and not working in the equity side, I actually was unable to go and manage money doing equities because I hadn't worked in the industry. And one of the key components of being licensed is you have to have experience in the industry. So I sort of saw this as an opportunity to work in that side. So I brought my systematic strategy, which I traded futures with, and just simply applied it to equities. And whilst I was at that bank, built quite a big business doing that. So that went for 4 years, and that's when I decided that was enough. I had the experience. I had that 3 years under my belt, and I went out on my own with Trish, my wife, and we set up our own business, which was purely equities based.
Nick, let's have a dig at the futures traders while we're here, just for fun. The mantra in futures trading, in like classic trend following, is that they have access to the wide array of diverse markets, non-correlated markets. So there's an argument for diversification there. Talk to me about what you think about that. And I guess I'm thinking of the fact that you just talked about the business of trading, right? So you wanted to raise money, so you wanted to trade equities, and it's a business motivated decision. And well, we're all here trading to make money. So how do you balance all of those things? And so, coming back to the question, it's like, well, what would you say to the diversification argument of trading futures?
Look, you're absolutely right. There's no doubt that trading a broad portfolio of futures contract that encompasses all sorts of very different asset classes, commodities, interest rates, fixed income, so on and so forth. That's absolutely diversified, as opposed to what I do now, which is primarily trade long only serially correlated instruments. But at the end of the day, Simon, it really comes down to risk-adjusted returns over the long term. That's what it comes down to. You can call it whatever you want. You can call it crisis alpha. You can call it whatever you want to call it. And yes, I think for institutional monies, there is certainly a spot for managed futures, for CTA, for commodity trading, that kind of stuff. Absolutely. I'm not sure that that's an argument Richard Dennis would have put forward back in his days in the 70s when he was swinging for the fences and doing all that kind of stuff. I think the industry has potentially changed, whether it's changed their narrative to suit their performance or whether they've changed their narrative to suit their investors. I don't know. It's neither here nor there to me. I'm happy with what I do. I don't think I need to go and trade futures, nor do I have to go and trade FX or Bitcoin or anything like that. That's a question I get all the time. Why don't you do this? Why don't you do that? Look, I don't have to. I think my returns are suitable for my goals as they are, and it's without the complexity and everything else. So call me old fashioned, call me getting old, but yeah, I'm getting old, and simple works best for me now. Do I miss the futures side of things? Absolutely. I absolutely do. I think it's great to have that big broad portfolio, but at the end of the day, each to their own. I'm happy with what I'm doing, and I'll let those pros in that area do what they do best.
Fair call. Nick, on this podcast, I like to really deep dive practical stuff and what people are actually trading. So can we do a bit of a high level overview, I guess, of, what's the broad set of strategies that you're interested in now? Because I know you've got a lot of different things happening between the chartist and managed accounts and so on. We can come back to that. But across that whole spectrum, I guess a lot of us have followed you over the years and seen that you've been pretty consistent, really, in what you've done. You've got a strong focus as a trend follower / quantitative momentum guy. You haven't really done a lot of chop and changing, but you've definitely added things and progressed. And so, yeah, very curious to know where you've landed at the moment. And I guess just a spectrum of different strategies that are on the table at the moment.
Yeah, so personally, I use 9 different strategies at the moment. They are all long only. They are all long only equities and or ETFs. And they are all, 95% of them are based on quantitative momentum. So if we go back to that late 90s area of time where I built my first systematic trend following strategy. So that strategy I still run today, but I just run it on equities. It's an absolute trend following model. Those that have read the Michael Cavell books or follow, the classic trend followers, that's exactly what I'm doing, just in equities. So nothing has changed in the last 30 years. That strategy still goes. But I've just added other ones onto there, and over time, we continue to learn, technology continues to advance, software gets better, data gets better, and with that, we evolve. So I'm no different to everybody else with a passion in it. I think, evolving is natural and healthy. But predominantly, since the day I started doing that moving average crossover, it's been trend following, catching those right tails. That's all it is. So nothing has changed in that context. Yes, I've gone down a few rabbit holes here and there. Certainly 2018, 2019, I went down a few rabbit holes looking at shorter term time frames, mean reversion, that kind of stuff. But over time, I've moved out of that again, and it just comes back to my personality, what I feel I do best, what I feel I'm comfortable with. We have clients in our mentoring program, for example, they're not comfortable holding positions overnight. Okay, that's fine. There's nothing wrong with that. It's a personality thing. So same with me, 95% of what I do is either absolute trend following / momentum. The other 5% is a small allocation to a multi-day mean reversion strategy. So that's pretty well it in a nutshell.
So 9 strategies, I presume some of those are the ETF strategies that we've talked about in the past. So I want to circle back to those. What's your outlook on relative momentum versus absolute trend following or absolute momentum, and sort of diversifying across Australia and the US? How do you position those kind of building blocks?
Yes, so I guess the first question is to define the difference between relative momentum and absolute momentum or absolute trend following. Absolute trend following is your classic trend following where you look at an individual symbol on its own accord. Is it breaking to a new 100-day high? Is it trending up? And you are looking at it on its own without relatively looking at anything else. Okay, so soybeans are trending up, BHP is trending up, Microsoft is trending up, whatever, trending up or down. Relative momentum is you're getting a very similar risk return profile. You know, you're trying to capture that right tail. But what you're doing is you're looking at the individual instruments in relation to every other instrument in the universe. So a very simple example, let's say we're trading the Russell 1000. What I would be doing is it's dual momentum. So first of all, I'm looking at the trend of the broader market and asking the question, is the trend of the broader market up or down? If it's up, then I come down a level to the individual stock. And then what I'm looking for is the strongest stocks measured by momentum over a look back window. Let's call it 12 months for argument's sake. There's plenty of academic research out there on momentum these days. It's a well-versed factor these days. You know, if we go back 15 years, not so much, but these days it's very well accepted. So what we're doing is we're measuring the momentum of all the stocks in the Russell 1000, and then we're going to buy the strongest ones. That's all we're doing. And we revisit that every single month or every single week, whichever it may be, and then we do it again. So those ones that remain strong, we continue to hold. Those ones that aren't showing that relative momentum, we sell them and buy the ones that are then showing the strongest relative momentum. And that's the process. So what we're trying to do is capture those outliers. Now, what we do know is that trends don't occur all of the time, but they occur enough of the time to generate a profit from it. So, you know, if we go back in the last few years, 2020 was a record year for me. And that was mainly because we caught Tesla. I think we caught Tesla at 30 or 40 bucks. I remember on my Twitter account talking about him, people going, you're a bloody idiot, you know, so on and so forth. It was straight after COVID. There was still a lot of doubt. But as we now know, in hindsight, the market absolutely ripped from about June through till the end of the year. So we caught Tesla very early and it just kept going and going and going. I think it peaked at about $340. Each year seems to have one. I think 2021 from memory was Moderna. Last year was AppLoving. 2022, there wasn't any. 2022 was a very nasty bearish market. Very nasty for us because it was choppy. Our Achilles heel with this kind of investing is a choppy sideways market. You know, if the market's going up, we're invested. If the market's going down, we're in cash. But you get a choppy market, that's kind of where we fall over. It happens. There's nothing wrong with it. It's a function of the markets. You know, you've just got to push through. Those that can push through will get good results, as we saw last year. 2024 was a good year again. So yeah, that's pretty much what we're doing. Just long only equities, pretty vanilla, no leverage, no esoteric products or anything like that, just straight equities.
What about just diversifying, Nick, over whether it's timeframes or parameter sets or regimes, so that, you know, do you have a multi-model approach within that strategy?
So what we're trying to do, even though we're whether it be in the Australian market or the US market, which are the two markets I'm involved in, we are trying to diversify as much as possible within that universe of a serially correlated asset class. You know, we're long equities. If we have a 1987, we're going to cop it. That's all there is to it. If there's a sustained bear market like there was in the GFC, well, you know, all those equities are going to go down. I think back in 2008, I think something like 97% of stocks on the Australian market finished lower for the year from where they started. So serially correlated means you're not going to get diversification within the asset class per se. So what we try to do to alleviate any sort of shocks or anything like that to the systems, we trade different parts of the market using slightly adjusted strategies. So to give you an example, in the Australian market, if we look at, well, let's use the US market as an example. So I trade a relative momentum strategy on the Russell 1000, and that's a monthly rotation on that one. I also invest in a NASDAQ strategy, which just trades the NASDAQ 100. Now, that was a strategic decision back in 2018 that I made because I had the impression that technology was going to be the next industrial revolution, which has come to pass. So I wanted a strategy that's solely focused on that part of the market. So we started that in 2018. So you've kind of got slightly different risk profiles and reward profiles, if you like, for those two portfolios. But then the next thing we do is we use different regime filters for each individual portfolio or each individual strategy. So the Russell 1000 will use one kind of a regime filter, and the NASDAQ strategy will use a slightly different regime filter. And the regime filters can be reasonably simple. Things being, for example, the S&P 500 above the 200-day moving average uptrend. Or we could use breadth, New York Stock Exchange, high lows, those kinds of things. So what that does is slightly tilt the portfolios in and out of the market at different points of time, depending on what's going on. And that just gives us that slight diversification, if you like. It's not a complete full diversifier like you would expect with managed futures or anything like that, but it's enough to sort of to help us diversify. Add to that, we have an Australian allocation and a US allocation. And, you know, prior to 2009, Australia was actually outperforming the US quite well. Obviously, since 2009, the US has gone absolutely gangbusters. Both have provided returns, but even when you bring it down to a month-to-month basis, you know, the Australian market just in the last few months has been performing quite well compared to what the US market has been doing. So that just adds a little bit of diversification there as well. So I wouldn't call it, you know, pure diversification like the theorists would, but in terms of just slightly adjusting allocations, that's what we're trying to do.
Yeah, and the geographic diversification between Australia and the US also just makes that difference. Do you try to tinker with the allocation between those two regions, or it's sort of 50-50?
It is 50-50. I made a mistake. As I said, 2020 was a record year, and that was all US based. And I didn't rebalance at the end of 2020 or the end of 2021. 2021 was a reasonably good year as well. I didn't rebalance, and I should have, because 2022, you know, pretty nasty. And much of that was just being too overweight the US. So, you know, you live and learn, you move on. But you know, it's very difficult when a particular part of the market is ripping and doing you favors. You don't want to say, right, I'm going to move some of that away from that. You know, I'm in that kind of, you're doing the right thing, do more of it.
Yeah.
Which, you know, from a risk management perspective is actually probably the wrong thing to do. Well, it is the wrong thing to do. Which, you know, that might lead into the talk about our all-weather strategy where we actually do that.
Yes.
So, yeah, look, we try and keep it as matched as possible between the different strategies and between the two, you know, US market and Australian market.
So while we're still on this then, do you have a philosophical outlook on, what works better in Australia versus the US, given that they are different markets? What are the differences in those markets? How does that play out and how you execute on them?
Yeah, that's a good question. And absolutely, I do believe. One thing I learned back in the late 90s with my futures trading, we tended to find that trading the Russell 2000 futures contract was a lot more profitable than trading the S&P 500 contract. Now, the Russell 2000 contract, not very institutionalized compared to the S&P 500, which was very heavily institutionalized. So, what we've found in our research with equities is that the more institutionalized the market, specifically the US being heavily institutionalized compared to Australia, we tend to find that absolute trend following doesn't work as well as relative momentum. So in the US market, all our strategies are relative momentum. I do not use any absolute trend following strategies in the US market. But in the Australian market, which is not as institutionalized, and we can define that in a second, two of my strategies are relative momentum and two are absolute. So bottom line, my opinion is that if you have a lower institutionalized market, such as Australia, such as Canada, and other markets, you will probably find that absolute trend following will work significantly better than trying absolute trend following in a more institutionalized market.
So tell us about institutionalized, yeah.
Sure. So I guess if we use a basic example, if we have a look at, the top US stocks, in terms of the number of analysts that cover those stocks, you're talking 50, 60 analysts covering the big stocks. In Australia, the biggest stock, BHP, Commonwealth Bank, they would probably have 19 or 20 analysts. As you go down the S&P 500, I think you've got to get down to around number 250 is when you get down to about 20 analysts. In Australia, once you get outside the top 10, you come down to about 5 analysts, 4 analysts, and really outside of the top 200, you might have 1 or 2, maybe 3 analysts covering a stock. You've got to get outside sort of the Russell 1000 before you get down to that kind of level. And the other thing as well, in Australia, I think 80% of the market capitalization is the top 10 stocks. So one of the portfolios we trade, as an example, excludes the top 100 stocks. And that, again, offers us a lower correlation to what everybody else is doing because they're all sort of indexing, and most of it is indexed into that top 100, and therefore they're just going to get index returns. So, but institutionalized, we do find that absolute trend following doesn't work as well as lower institutionalized. So Australia, Canada, again, not as many analysts. I won't call it less efficient, but I don't have a, academic reason why that would be the case. It's just my experience, that's all.
Yeah, well, trading is about looking for those inefficiencies in the market, isn't it? So if the US market is more efficient, then it makes sense that we would exploit the inefficiencies that we can find elsewhere. So I like that. Just before I move on to the all-weather strategies, Nick, with the Aussie stocks there, so because this is intriguing, so the more absolute trend models that might continue to work here. You mentioned that one was based on principles that you had developed many, many years ago in the futures markets. So can you just give us a little bit of a hint as to, what drives that model?
Sure. So that's just your standard breakout type model. I'm just trying to think of the name of the trading system. There's a famous trading system back in the 90s. And for the life of me, I cannot think of its name now, but that's where it started. Just pulling that to pieces and having a look at the insides of that, what it was doing. So yeah, not much has changed from those particular days, the entry mechanism, that kind of stuff. I've made a couple of slight adjustments to it. For example, adding a regime filter. That old futures trading system used to use a trailing stop, which was a moving average. I find with equities are too sort of noisy for a moving average type trail stop. So we have a slightly different kind of trail stop. But for all intents and purposes, it's a breakout strategy and it's an absolute trend following. So we're looking at breakouts and then the individual stocks themselves.
And let me ask about, I guess, this first, which is the discretionary element, even when one is a quantitative trader. And there's a couple of things that we've riffed on before. So one is the stage in life that you're at, whether you're in a wealth preservation or a wealth creation phase. And the other is just an outlook that one might have on the global economy. You mentioned making a call earlier about tech, which turned out to be very prescient given the AI rise since then. So that's just really compounded that decision. So, what's the role of that? What's the art, the discretion that is part of making these trading decisions that even a systematic trader has to make? What strategies they will deploy over what time frame and things like that. What are your thoughts on that sort of more qualitative element?
Yeah, so I guess the major changes I've made over my life are more lifestyle choices. The first time the decision to go from futures to stocks, that was based on a business decision essentially. Now, as I get older, approaching retirement, I've spent 25, 30 years using higher growth strategies that comes with volatility. 2022, as I said, had a 30% drawdown across my accounts. And that's not something that I want to have occur again in my retirement account as I come into retirement. It's called sequence risk. You want to protect what you have so you're able to draw from that going forward. You don't want to be drawing from a capital base that's 30% lower than it was a year ago, before you retired. So in my retirement account, we have certainly made a discretionary switch, and that was to move to again, it's a quantitative momentum portfolio, but it is solely designed to suck the volatility out of the portfolio. Solely designed that I can still get some okay growth without having to deal with double-digit drawdowns. So that's the all-weather strategy. I still maintain my other portfolios outside of my retirement account. They're in a family trust or in different company names. They are still trading as they've always traded over the years. But, the retirement account that's been going for 30 years, that's a very important asset going forward. And I don't want to see that, self-destruct, if you like, or go into a major drawdown. So that was a discretionary call, and call it just a stage of life call. As we get older, we sort of, I won't say that I don't want to take on risk, but I just don't think it's necessary. So I think I'm at that point with that particular investment allocation, in that we still want a bit of growth, but we don't want to be silly about it because we don't want to have that big drawdown.
Tell us about sequencing risk. We've discussed it once before, I think, on the show, but it's actually a really important principle.
So sequencing risk is the sequence of risk relative to your retirement. Okay, so we all know that as you're younger, you should be taking on more risks because you will be able to recover from those downturns that occur. So a 20-year-old should be taking higher risks, be in higher growth assets, be 100% allocated to equities. And the old rule of thumb, I think, is your age should be the allocation to defensive equities. So, if you're, say, 40, you should have 60% in growth assets, 40% in defensive assets. When you're 50, it should be 50-50, so on and so forth. So as you get older, you have a higher proportion of your allocation towards defensive assets. Defensive assets, traditionally meaning bonds, that kind of stuff, fixed income, we can call it gold, whatever. as opposed to growth assets, which are basically equities. So sequence risk is the relationship of your capital and its associated risk with regard to when you retire. So when you retire, when you go into pension phase, you want to be able to draw as much income off that capital as you can. If you, say, for example, retire and the year before you retire, you have a 35% drawdown, then your pension is going to be significantly lower than what it would have been a year prior. So as we approach, that retirement age, I don't want to be in a position where that account capital is going to be 30% lower or whatever it may be. If you look at a basic buy and hold type portfolio and we go into a 1970s situation, which, let's face it, could be quite realistic going forward, you don't want to be in a situation where your portfolio is in a 60% drawdown, because you need to be drawing an income out of that. So sequence risk is what your risk is in relationship to your retirement and how any kind of drawdown will impact on your retirement income going forward. So to alleviate that, what we want to do is alleviate that downside risk, or the better way to measure it is in volatility. So volatility is what we're looking for.
The way that I like to think about that risk too, even for those traders who are not nearing retirement, is just to remind them that a statistic in and of itself, a win rate, an expectancy or whatever, is an aggregation over time. That's very different to what's going to happen in the next 5 trades, the next 10 trades. And that's just an important principle to embed in one's thinking, isn't it?
Yeah, I think you need to, one of my favorite sayings is next 1,000 trades. It's very easy to get swayed by a bad run of short run of bad trades. Have 5 bad trades in a row and people make a lifelong decision based on that. It's just not acceptable. We have people who, said, I'll give it a go for 3 months. It's like, mate, don't bother. You're wasting your time. You've got to give it 2 or 3 years. You've got to allow the law of large numbers to play out. That doesn't play out in 10 trades. It plays out in hundreds and hundreds of trades over time. So, this is why you see a lot of fund managers give you a suggested time frame. They're not trying to keep your money for 5 or 7 years. That's not the point. They're trying to say, to get the full benefit of what we're doing, whether that be over the economic cycle or what, you've got to invest for 5 to 7 years. Anything shorter and you're just killing yourself, it's a waste of time. So one of the things we like to do with new clients, and I've certainly sat down with some before, we can work out the probabilities of making money in any window, but let's call it a 12-month window, because people tend to put a time frame on their success, which is the complete wrong thing to do. We're investing in dynamic markets. These 12 months is not going to be anything like the last 12 months and won't be anything like the following 12 months. So putting a 12-month window on something is a pointless exercise, but it's predominantly what everybody does. So what we like to do is calculate the probabilities of making money in any 12-month window, regardless of the day you start. So today, what are we, October 22, we would say, okay, if you start today, in 12 months, you've got an 86% chance of making money, or you've got a 91% chance of making money depending on the strategy. Now, the thing with that is not the probability of making money, it's the probability that there's a 14% chance you may lose money in that 12-month window. So if you put a 12-month guide or guardrails on your success, well, you've actually got a 14% chance of not meeting that. And I've seen it in the past. Clients have said, well, I've done it for 12 months and I've lost money, so you're no good. And that's why
it was the sequence. It was the time that they got on board.
Start date error. Start date bias is really what it's all about. I remember vividly back in 2010, we had a guy join us. He had never traded before in his life. And his first year, he made about 74%. Now, he's been a client ever since. he was off the right track. And as much as I would like to predict that, yeah, now's the time to start because you're going to make money, I have no idea. But because he had that positive start, he was more able to push through, and he could see what happens, as opposed to someone that starts and has a bad start. They may not see what is possible because they haven't allowed it to happen. And if you're not there for the good times, if you don't allow yourself to be the good times, you're not going to catch the good times. So, no one can know when the good times are. So what you've got to do is, when the bad times come, which they come for everybody, is you've got to push through. And I think that's a big difference between a professional trader and an amateur, is the ability to stick with it when things get tough. 2022, it was a pretty tough period of time. I was saying to my investors, I got one investor send me an email. He was very new, and he's going, "What is going on?" I said, "This is normal. Here's the evidence. It's happened before. It'll happen again. But what we do know is that over time, we'll get through it and we'll push through." And he stuck with it. And, last year he made 48% return. So if he'd given up, he wouldn't have been there for those good times when they come along. And considering the stock market has a upward bias of whatever it is, 84, 86%, it's only a matter of time, on average, that those good times will come along. But if you're not willing to be there for them, well, sorry, you're not going to get them, and that's why people go into this, what I call, the beginner's circle, if you like. They try something for a very brief period of time. That doesn't work. I'll try something else. Oh, funnily enough, that doesn't work. Boom, boom, boom. And around and around and around they go. So
you're probably always just 2 steps behind the thing that is working. And if you'd stay, a stopped clock is right twice a day. So
correct. And, the analogy, we can take it to any other, conquest in life, whether it be study. You don't go to university to become a doctor and expect to get your degree in 6 months, right? It takes years and years and years. But because we understand that, we do it. And the easiest analogy I can think of is traveling, for example, from one side of a major city to the other side of a major city. You're going to run into red lights, you're going to run into roadworks, you're going to run into congestion. But because you accept that as part of the journey, you are willing to push through. For some known reason when it comes to trading, oh no, I can't have a losing month. I can't, So it's a real psychology kind of thing. But I think as I've matured as a trader over the years, and look, it's been 38 years, so I've had plenty of practice, and probably call me punch drunk, but drawdowns just don't bother me at all. It's just, it is what it is. You just got to roll with it. If you go and study, which I have, go and study all the great traders. I've looked at track records of some of these traders that have been around 40, 50 years. They're still around today, and they've been through some pretty bad times. But what makes them stand out is they push through, they keep going with their process, they don't change anything. And I think you get to a point, call it punch drunk, whatever, call it experience, but you accept that drawdowns, as hard as they are a part of the whole game. So you can't have one without the other. I've met thousands of traders in my time that love making money. I've met none that like losing money, but it is what it is.
I find this one of the great ironies, really, that when we're assessing a trader or a fund manager, the reality is the trader or the fund manager who's been through some hard times is probably now a better trader, because they've had to learn through that, and that would have had a significant impact on their development process. And you also mentioned before, the 87 crash. You've been around for a while, so you saw the paper littered on the blood on the streets after that kind of event, and even for March 2020 COVID crash, things like this. Even if we get lucky and sidestep those things or not, we've actually got to stop and learn from them, don't we? It's like in the back test, realizing that we could have just subtly avoided the pain in the back test and thought everything's okay. But if we're not preparing for those worst case scenarios, we're doing ourselves a grave injustice.
Yeah, it's interesting you mentioned 87 and 2020. I actually lost a lot of money in 1987. You know, being young and stupid, I deviated from my 5 and 10 day moving average crossover system. Had I been doing that, I would have been short into the crash. But I was young, stupid, greedy, and was doing something else. And so I lost double my annual salary in 87, and my father had to bail me out, and I spent the next 5 years working in a pub, pouring beers at night, trying to pay him back. Move forward to 2020, and we did, with luck, and I'll put it down, nothing more than luck, we did step aside, and we were in cash in March 2020. Pure luck, don't get me wrong. But even so, 2022, something like that, you know, it's a grind. You put trades on, they go immediately bad. You stop them out and they go good. You put them back on, they go bad, and it just goes around and around, and that can grind people down. And as you quite rightly say, you can look at a back test and you can see the pure, you know, upside in it all, and you don't see the little bumps. One of the little exercises I like to do is use a trade simulator over different windows. So you put your expectancy numbers in there and you run it on 1,000 trades, and you get a nice equity curve, and then you run the exact same expectancy on 20 trades, and it's just completely different. You could have 19 out of 20 trades losing, even though over the 1,000 trades you've got this beautiful curve. So I think it's very, very important that people look inside their equity curve. They look at the smaller windows, because the day-to-day managing of your strategy and your day-to-day trading, that's what you've got to deal with. You've got to deal with the ups and downs. You know, today gold fell 6%. Well, gold's been going through the roof. I've been long gold for 2.5 years, and a lot of positions and a lot of my portfolios are gold related. Now today, gold down 6%. I can tell you it's nasty. Not a pretty look, but it is what it is.
Yeah.
And we simply follow the process, and we don't get emotional, because the process has enabled us to get to this position in the first place. So we don't want to deviate from that process now.
So Nick, you've gone back to managing money.
Yeah.
So can we deep dive the strategies that you're running inside there? Can we talk about your all-weather trading?
Sure. So we run two strategies. One is the high growth kind of relative momentum that we've been talking about. And then another strategy we offer is the all-weather strategy, which is the one I manage 100% of our super fund with. So that's our retirement account. So I have 100% of my retirement account in that particular strategy. So the all-weather strategy is designed to have very, very low drawdowns. I'm talking single-digit drawdowns, very low volatility, and still get some kind of reasonable return. So the way the strategy enables us to do that is we're trading different asset classes using what's called tactical asset allocation, which we can talk about very shortly. So when I say different asset classes, we can broadly put it into two buckets. One bucket will be growth assets, namely stock indexes. And we do this all through ETFs, by the way. So we'd be trading the S&P 500 ETF or the Russell 1000 ETF or the Global 100 ETF. And then the other bucket is our defensive assets. So defensive assets would be commodities, gold, bonds, fixed income, that kind of stuff.
No Bitcoin in there?
Yeah, there's a small allocation of Bitcoin into alternates. So only 5% is allocated to that. So what we do is we balance between those assets on a monthly basis. So it might be good to step towards the definition of what is tactical asset allocation.
Let's start there
before we go. Yeah. So the traditional all-weather approach, which was founded by Ray Dalio back in the early 90s, he does the same kind of thing, a little bit more complicated, but let's just keep it simple. So he's investing in various assets to keep volatility low. So he might have 20% in growth assets and various bonds and inflationary bonds and gold and that kind of stuff for inflation. So what he's trying to do is get steady returns, not hit for the fences, but steady returns over any economic environment. And the way he would do that was allocate to these different assets, hold them, and then just rebalance on a regular basis, whether that's monthly or quarterly, I don't know, but just rebalance and keep it going. So that's the classic example of asset allocation. We take that one step further and do what's called tactical asset allocation. We're doing the same thing, but we're only wanting to hold those assets when they're showing positive momentum. So we've been long gold for the last 2.5 years. In a classic example, we would always hold gold regardless. In a tactical allocation, we're only holding gold whilst it's going up. So if last night was the top in gold and we do go from whatever, 4,300 back to $2,000, I'm not going to be involved. I'm going to be out. I'm going to be long gold. Same with Bitcoin. We've had Bitcoin since 30,000. It's been to 124, 125. Mm-hmm. It's back to 107. If it goes much further, I'm going to be out of that. And I don't care if it then goes back to $10,000. If I do get out and then the market does turn back up again, goes back higher, well, I'm going to get back in again. So the tactical side of it is simply moving, using our relative momentum mechanisms, moving in and out of those assets whilst they're trending up or down.
You know, again, you've got an Australian-US split. Can you tell us a little bit about how you've diversified across geographies there and just, you know, the kinds of ETFs that would be involved in each?
Sure. So we use a very vanilla type of portfolio. So if I want exposure to gold, I want exposure to gold. I don't want to be in gold miners. I don't want to be in any kind of gold strategy or anything like that. I just want to be having gold. So we've got gold in Aussie dollar terms and US dollar terms. So we'll have allocations to both of those. And we'll have exposure to Australian equities, US equities, global equities. There's no Bitcoin in the, well, there is, but there's just not enough liquidity or data for that at the moment. But Bitcoin, you know, the IBIT ETF in the US is the one we use over there. So the first rule is that we just want the very large, very vanilla ETFs for that very broad exposure. We don't want to go into really esoteric types of ETFs which give you some other kind of, you know, some other kind of exposure that we're not looking for. Yeah. You know, in this day and age, there's so many different types of ETFs. So we want those big ETFs. They're going to be tracking those bigger, broader markets that we want exposure to. So that's really the key. And they're the ones that got the longer term history. You know, some of these gold ETFs go back 25 years or so. The stock index ETFs go back, I think, you know, Australian ones go back to 2000. I think the S&P goes back to the 90s. So, you know, there's a lot of history there. So what we're doing is we are trying to balance that portfolio. Traditionally, because it hasn't been happening in the last 2 years, gold and equities will move against each other. So equities up, gold will go down, vice versa. Okay, so that's where you get this lowered volatility. In the last 2 years, however, we're seeing a situation that was last seen back in the early 70s where there's been a massive injection of liquidity into the markets, and we're seeing all hard assets go in one direction. So, you know, equities up, gold up, Bitcoin up, everything's going up. That's not going to last forever. And when we do get that liquidity removed from the market, we will go back to the traditional situation where gold, for example, will move opposite to equities. So we've been very, very lucky in the last 2 years because we've had this very, very nice tailwind. But we need to be cognizant that that's not the way it's going to be over the long term, and we don't expect it to be that way. So the other thing we do, as opposed to what we do with our higher growth strategies they will ride a position, and that position, should it keep going, will become a larger portion of the portfolio. So let's say, for example, I mentioned Tesla back in 2020. Let's say we've allocated 5% to Tesla. Well, when that 5% grows and grows and grows and it gets to 20% of the portfolio, you get a lot more volatility. Tesla only has to have one big down day and you've got, a nasty day right there. Whereas with your weather strategy, we're constantly rebalancing each month. So one position, for example, gold, which we've had for 2.5 years, we've had the core position for 2.5 years, but as it's gone up, we've slowly offloaded some. And when it goes down a little bit, we might have to buy some more back. But for the whole period of time, we've maintained that percentage allocation to that product. And that's what keeps that volatility down. No single position grows too big to cause it to get wild.
Yeah. So there's this monthly rebalancing in a sense. Can entries or exits only occur on that monthly basis as well, or can they potentially happen at any time?
No, only at the end of the month. Yeah. So one of the things, we've learned is let the market do what it's going to do. If you have too tight a leash on the market, you're just going to get caught up in noise. So just by rebalancing portfolios at the end of each month, and a lot of people will argue, well, monthly, that's too much. A lot of fund managers do it quarterly. We can do it quarterly. But it just allows the trends to develop and removes the noise from the market, So yeah, we could do it weekly. You could almost do it daily if you really wanted to, but doing it monthly seems to be quite a nice balancing thing. I guess if you had some extreme move intra-month, something silly happened, if gold did go up 50% in a month, highly unlikely, but if it did, probably you would have a discretionary override and say, all right, well, that's just a little bit silly now, so I'm going to bring that back. You could do something like that. Not necessarily going to happen with the all-weather strategy because you're trading such big, broad assets. But if we're looking at the higher growth strategies, something like app loving last year, from memory, it went from, $20 or $16 all the way up to $160, pretty quick, smart, something like that. So it becomes such a big part of the portfolio that common sense prevails, and you should take a little bit off the table and just rebalance the portfolio.
So the higher growth, you just mean these momentum models on stocks?
Correct, yeah. Stocks obviously have higher betas than the ETFs, so that's where you get your volatility, and that's also where you get your return. You can't have one without the other. Volatility is a measure of your risk. As a rule of thumb, multiply your volatility by 1.7 or 2, and that's kind of what you would expect your maximum drawdown to be at some stage in the future. So if you've got a portfolio, let's take the average stock market, it has a long-term volatility of 15, 16%. There's an absolute certainty that you will have a drawdown of at least 32% at some stage, which, as we know, has happened. 2020 was the last time it happened, maybe even 2022. But, it's bound to happen, as opposed to a strategy that has a volatility of, say, 5%. Chances are your max drawdown is going to be 8 to 10%. So there's a big difference there.
Running strategies on ETFs, say something like GLD, trading gold, the history on that might not be as extensive as the gold futures. I don't know if I'm using a correct example, but in that case, I'm sure I'd be right. So there would be an opportunity to sort of synthetically add some of that gold futures data to an earlier history on the gold ETF data, or just use the futures data to test over a longer period. Have you felt that that's ever been necessary, or the ETFs that you're choosing are, they've been around long enough?
So, to answer your question, yes, you could. I'd be inclined to use the spot LME gold price, which goes back to 1968, I think, from memory. You could use that if you wanted to. I think it's important to understand that more recent data is more important than earlier data. We did have a situation recently. I know a very vocal critic said, you've basically been lucky for the last, and he wasn't talking about me specifically, he was talking about momentum traders. And he says, you've just been lucky over the last 20 years because of this slow inflationary, low interest environment we've had. Considering that's fine, considering most retail traders have got a window of about 3 months, whatever. So what I did with that is, I did go back. The system that I built from data for the last 25 years, I took the same parameters and went back to 1955. And the strategy works perfectly well. So that's a proponent of having a very robust, simple strategy and then applying it over all those different market environments. We had an investor recently who sort of had a bit of a panic when Trump went into Iran and said, we've not had this nuclear sort of threat before, blah, blah, blah. Well, we have, the Bay of Pigs. We have seen this before. So if you go back to 1955, it's a significant period of time, 70 years. There's a lot has gone on. And if you're using the same parameters that you built the strategy on the last 25 and it still works perfectly well on the prior, it gives me a great deal of confidence going forward, So coming back to your question, I think your bias should be on more recent data. Certainly, 20 years, there's nothing wrong with that. I guess if you want to be a perfectionist, you can extrapolate other data out and do all that. I know, I did a presentation recently on the momentum ETFs that are very new in Australia, but they've been listed in the US since 2013. So the question was, well, how would have these performed in the GFC in 2008? So I was able to get the data for the underlying index on that momentum ETF and go all the way back to 2000. And as expected, it was pretty bad. It was a 56% drawdown in 2008. So, it makes sense, but keep it simple. It's not an exact science. And it's important to also understand that, your system's going to get you out if we do go into a sustained bear market. The weekend trend trader, it's going to get you out. It's going to happen. It'll do it automatically. You don't have to think about it. You don't have to predict it. Just let it happen. It'll get you out. Obviously, each sell-off may not be 2008, and certainly in the last 8 or 9 years, any sell-off we've had has just bounced straight back. So I think you've got to be careful that's not to be thought of as the new normal. It's the current normal, but it's not going to be, if we do go into a hyperinflationary environment in the next 2 or 3 years, the following years, we could see a repeat of the GFC or the 70s or something like that. We'd probably at least see a lost decade. Strategies like the weekend trend trader actually do particularly well in those lost decades because they're able to get any gains when the gains are there and stay in cash when they're not there. So in a lost decade where the market moves sideways for an extended period of time, these absolute trend following or relative momentum trend following strategies actually work quite well.
And with these allocations, Nick, like you've got, let's say, X% to gold, X% to equities, then global equities, bonds. Now, a couple of questions. One, if they're all moving up, then you could be involved in all of those at the same time, right?
Yeah.
And if they're all moving down, you're in cash. And so on average, there's only a couple perhaps that you're involved in. So it's a fairly low exposure kind of strategy too. Is that fair to say?
Yep, that's fair to say. Low exposure. At the moment, we're 100% invested at the moment, but that would be the first time for the last 2 years we've been 100% invested. And that's kind of what you want to expect because things like bonds and gold, in theory, should be going opposite to equity. So if you're long equities, you should be flat gold and bonds. So we've been flat bonds for quite some time. We're back into bonds at the moment. Also commodities, for example, a commodity ETF that's been pretty poor performer over the last year or so, believe it or not. And that's mainly because of the influence of oil. But, at the moment, as we speak, we are 100% allocated.
And what sort of influences the percentage allocation between those different assets?
So we kind of modeled everything on the 60-40 type style, where you have 60% growth, 40% defensive. The Australian portfolio is actually 50-50. I think the US is 60-40, or the other way around. But even those two individual portfolios are slightly built slightly differently as well. And again, that just adds a little bit of diversification, if you like, to how it's selecting the instruments, So the US portfolio is static. We only trade 6 ETFs, and that is it. And it's a binary position. You're either in that ETF or you're not. You don't go into a similar ETF. It's either yes or no, binary, which means if equities are going down, well, we're going to be holding whatever that is, 50, 60% cash if equities are going down. Conversely, the Australian one's a little bit different. It holds two buckets. One bucket is growth assets, and there'd be 6 ETFs in that. And the other one is defensive assets, and there'd be 6 ETFs in that. And what it's doing is it's selecting the 2 strongest growth assets in that bucket and allocating 30% to each of those 2 strongest. And then it's looking for the strongest defensive asset in the defensive bucket and allocating 60% to that. So it can select across different ETFs in each bucket, if you like, as opposed to the static one.
Yeah.
So again, it provides a slightly different risk-return profile between the two of them.
Yeah, I love the diversified approach across the different style variations. I've always been a big fan of that. So I guess, when just starting to wrap up to the back end, Nick, I think of Nick Radge, and there's a few things that come to mind, right? So I already mentioned that you've been a kind of a consistent, trader promoting the same principles, trading the same kinds of strategies for a long time. So the word that comes to mind there is robustness, that you're looking for robust, enduring models. So I think of you, I think of robustness and simplicity and logic-driven approaches, consistency, that deep level of experience, having been through this many cycles. I obviously think trend following, I think diversification. So we've been, and of course that you've just been such a huge contributor to the community, which we all appreciate. So I'll mention that as well. Having you now in front of me just to touch on some of those, like robustness, building things that are robust, that are enduring through time. We've had different opinions here on the pod, different ways that people have handled portfolio development. Obviously, your shorter term futures guys, they can cycle through strategies very quickly. We've had machine learning kind of ideas. So what kind of processes do you apply when you're thinking about these models, when you're building models, to make sure that they are in fact this robust?
Yeah, so I think the process, I think the key question every trader needs to ask themselves is, why am I making money? What is the driver of the P&L? And with trend following, that's very simple to answer. It's how much you win when you win versus how much you lose when you lose, and that's it. And the end of the day, every trader from Warren Buffett all the way down has the same metrics, right? They have a win rate, loss rate, and a win-loss ratio. So it's about creating that. You either have an entry edge, okay, where your entries are putting you in a very high win rate in excess of 80, 85%. So that's an entry edge. Or you create your own edge with your win-loss ratio. And that's the easiest way to do, and that's what I do. I'm not smart enough to do the other way. The other way, you either got to be super smart, which I'm not, or you've got to be optimizing, data mining, making strategies that are less robust, which is interesting because it seems that all short-term systems sort of fall into that category. You mentioned before, people are cycling through so many different strategies. Don't get me wrong, there's people out there that have the ability to do that. But for the very vast majority, by the time you figure out your strategy's broken, it's usually too late. Okay. So my philosophy is to answer the question, why will a strategy make money? Why is it making money? Because I'm capturing that right hand skew. That's what I'm capturing. So long as I cut my losses and then I let my profits run, over the long term, I'm going to be fine. I can't not lose. Trends have to happen. They can't not occur. Doesn't mean they happen all the time, but they can't not occur. For a market, for markets not to trend means that every equity is fairly priced and all humans are acting rational, and we know that's impossible. Okay, so that's the question. In terms of building the mechanics, and I should go back, if you can't answer that question, why is my strategy making money? You're going to have a very difficult time when your strategy is losing money to say, well, why should I stick with this? As I said, back in 2022, when an investor said to me, what the hell's going on? I could tell him exactly what was going on. I could show him mathematically why we were losing money and why that was only a short-term aberration. And he was completely happy with that. So if I went to him, you know what, mate, I actually don't know what's going on. I can't explain it. It's a very different kind of ball game.
Yeah.
So that gives me confidence. In a 2022, very difficult period of time, but I had full confidence that all I had to do was just deal with it, get through it, and the good times will come back, which they have. So that's the first question. The actual dynamics of building a robust strategy, you just got to keep it simple. I think if people could see what was in the strategies that I trade, they would be amazed about how many or how limited the number of parameters would be. I have a very strict kind of way to build strategies to start with, and then a way to manage them going forward. And as I said, my initial trend following on that we traded futures with back in the 90s still goes today, more or less exactly the same. Hardly things have changed in that period of time. So, I think if you do it right, it's not going to be the optimal beat all end all. There's plenty of traders out there who've got much better performance than me. But the thing is, you do this over 38 years. You kind of let the, eighth wonder of the world compounding do its job. You don't have to be hitting 100% returns every single year. You don't have to go and do that. You don't have to use leverage. Simple system applied for the long term, you're going to beat 99% of the people out there, and that's all that matters.
You said you had a strict build process, and are there some classic principles that you always like to apply, whether it's variance testing and skipping trades and Monte Carlo or multi-market testing? Are there things that are stalwarts in your toolbox for that kind of robustness testing, out of sample?
Yeah, so I think first and foremost, I think you've got to look at the number of parameters that you're using. Then you've got to look at the parameter settings that you're using. So to give you an idea, if someone comes to me and they want to build a strategy, I say, all right, well, if you want to build a trend following strategy, okay, well, you need a regime filter. You need an individual stock filter. You need an entry mechanism, ideally something simple like a 100-day breakout, and you need a trailing stop loss. And that's kind of where you start, right? From that point, you got to choose a parameter look back. And, where you want to start with that is you just use, this is just my opinion. I'm sure people will disagree with it, and that's perfectly fine. Seems to be okay for me over the years, but I start with a round number. Okay, whether that be 100 or 200 or whatever it may be, a round number. That's where you start. And then It could be a common sense number like 21 trading days in the month, 21, 42, 63, something like that. But it's got to make sense in that. And ideally, if you've got two parameters, let's say, for example, a trend following strategy where you've got a regime filter and you've got an individual stock filter, ideally you want them to be the same length, okay? You don't want your regime filter to be 293 days and your stock filter 26 days for that. It just makes no sense, right? If they're both 200, then you're going to be a lot more robust. So that's the first thing. And then what you will find with your parameters, you will find there will be one parameter that is the most volatile. Okay. So what you want to do is you want to optimize every parameter as granularly as possible. You don't want to optimize it to find the best parameter. You want to optimize it to find out which parameter is the most volatile.
Mm.
And when you find the parameter that is the most volatile, that is the parameter that you monitor on an ongoing basis. So, for example, with a trend following strategy, we'll find that one parameter every year. We will do an optimization on the past 5 or 6 years worth of data, find a statistical flat spot for that parameter, put it in the middle, and that's what we'll use for the next year, and then do it again. But we only do it once a year, and we only do it for one parameter, and that's the most volatile parameter.
Mm.
As soon as you start going and doing it for every parameter, you just go down that rabbit hole and you'll never come back again.
Yeah, and I think something I've heard you say before, which is related to that, finding the most volatile, is that the scientific approach is to try and break the strategy, right? So if you try to break it, you're going to know where the weak spots are, and you're going to know what you need to do to avoid the damage, and you can validate it by trying to break it.
Yeah. So I saw a really good example of this just the other day. There's a strategy going around at the moment, and it looks fantastic. It uses exponential moving average. If you change that exponential moving average to a simple moving average, it completely falls over and fails.
Mm-hmm.
So to me, not that that's a robustness test that we would do, but that gives you a very simple analogy of what, that shouldn't make that big a deal of difference, whether you use a weighted moving average, simple moving average, exponential moving average. It shouldn't make a big deal of difference. But if it goes from super profitable to falling over and being a losing strategy, then there's something wrong with it right there, okay? Yeah. Other red flags, in my view, single market systems, okay? To me, immediately, a single market system is just a red flag. And yes, I know there's people out there. Kevin Daly is the best known one, and he's got the results to show it. But, obviously he's very, very good at what he does. He's the Tiger Woods of doing that stuff. And I don't think anyone else in there should be putting themselves in his shoes. Like, if you're going to go and play golf, well, if you think you're Tiger Woods, well, you've got to ask serious questions. Mm-hmm. So single market system opens itself up immediately to data mining and optimization. And that's why you probably see a lot of these short-term futures traders cycling through different systems, because they've just optimized it for a period of time. And by the time they realize it's not working anymore, it's kind of too late. So what we would do, for example, we would create a relative momentum strategy on, let's call it the Australian ASX 500, okay, the All Ordinaries Index. So to stress test that, what we would do is a variety of different things, but the basic test would be to take that exact same strategy with the exact same parameters and put it on a different part of the market. So you'd put it on the whole of the Australian market. You'd put it on the whole of the Australian market X the 500. Then you would take it and stick it on the Russell 1000, a similar kind of market, or put it on the Toronto market or something like that, okay? Now, it's not going to be perfect, but it should be reasonably stand-up-ish, if you like. If you've got a strategy that makes a 22% annualized return with a 15% drawdown on the ASX 500, and then you go and put it on the broader Australian market, it may have an 18% return and an 18% drawdown. It's still in the ballpark. it hasn't fallen over. It hasn't produced a minus 10% return with a 60% drawdown. Okay. So just those little tests help. Other things we do, for example, is we may, let's say, for an example, a longer term strategy uses the closing price to generate a signal for tomorrow's opening. We might vary that closing price by 5% and randomize that and then run the tests again. We can randomize the parameters, randomize the data, all those kinds of things. So again, it's about how can I break it? How can I introduce other data that has not been tested on before? And that's when you can bring in another market, okay? Stuff like that. So, this system that's going around, this single market system that's going around, well, the other day is for shits and giggles. I coded it up and put it onto all these individual other instruments, and they all fell over. And some of them have never been profitable. So it just doesn't stand up, And there could be an argument, oh, this market has a certain mannerism in a certain way. The problem with that, and this is one thing I learned from trading futures back in the 90s, markets change over time. Their personalities and their mannerisms change. I remember back in the 90s, the British pound was didn't trend at all. It was a terrible market. I knew as soon as we got a buy signal for the British pound, we're going to lose money. Whereas the Japanese yen was just flying. It was trending beautifully. And that's completely the other way around now. So markets change over time. We have to accept that markets change over time. So if you've built a system to profit from a certain instrument that has performed in this particular way for this particular period of time, there's a very high chance it's not going to do that into the future. So if you rely on that, you're going to be behind the game, as opposed to what we do. So, let's take, for example, we're building a system on the Russell 1000. Well, yes, we traded on today's Russell 1000, but we've tested it on historical constituents of the Russell 1000, which is about 3,000 or 4,000 stocks historically. And we're using the exact same rules across every single stock, okay? So that in itself gives me confidence that the law of large numbers, there is an edge in here to be exploited, and that's what we do.
Would you say too, after 38 years of doing it, Nick, you sort of narrow down on really knowing what works, what principles work? There's a whole bunch of stuff you're probably just not going to waste your time on. And, maybe as we close out, you can talk about that in the context of trend followings, like why trend following, why momentum, what are some of the core philosophical enduring advantages of that approach?
I think there's two things. First of all, the mathematics behind it is easy explainable. We're trying to capture the right tail, and we can plot 500 charts or 500 performance charts and show that skew to the right, compare that to the skew to the left. We can explain the mathematics behind it. Pretty simple to explain. And second of all, we can also explain that trends can't not happen. They don't happen every year, but they happen often enough, and they can't not happen, as I explained before. Either all analysts have to value all assets perfectly, which we know is not the case because all their models are built up of different inputs, and people have to behave rationally, which we know they don't. So long as those two things remain stable, which they have for hundreds of years, I think we should be okay to at least the end of my career. I think that's the two key things, the ability to explain why the strategy works and why it will continue to work in the future. And if you can't explain that, then you're in trouble.
Awesome, Nick. Well, mate, I want to keep you on the line for another couple of minutes just to do some member content. But do you want to just wrap up with reminding everyone, if they don't already know, how they can get in touch with you and learn more?
Sure. So I'm on Twitter at The Chartist, or you can come to our website, thechartist.com.au. We've got a subscription service, which my son now runs. That's the service that we've had for the last 20 years. My focus these days is on managing money. So at this stage, we only manage money for Australian wholesale investors. We will be introducing a retail fund hopefully soon. So, if you are looking for different strategies that have lower correlation to, what your financial planner has put you in, or you like the sound of this all-weather strategy, which I have to say, dare I say, touch wood is the closest thing to the holy grail I've ever come across.
Mm-hmm.
We can have a chat about that. So that's Australian wholesale investors, retail fund coming. And yeah, look, we do mentoring and all that kind of stuff. So in between golf and fishing, I might be able to fit a few people in.
Awesome, mate. Looking forward to having a round with you soon. All right, Nick. Well, thanks so much once again.
Thanks, Simon. Great to be here. Thank you.